Charlie Munger. If you want to get rich, stop buying these 5 things. In the pantheon of modern finance, Charlie Munger was not merely a billionaire. He was the architect of rational thought. While the world chases alpha and the next 100x return, Munger built a fortune of billions by adhering to the principle of inversion. He didn't ask, "How do I become brilliant?" He asked, "How can I avoid being stupid?" Munger famously stated that it is remarkable how much long-term advantage people like him have gotten by trying to be consistently not stupid instead of trying to be very intelligent. In a financial ecosystem designed to sell you complexity, products, and dreams, the most profitable action is often subtraction. Wealth is not just about what you buy, it is about what you refuse to buy. Today, we are stripping away the noise. We are not discussing which stock to pick. We are discussing the financial poisons that Munger identified as the destroyers of capital. These are the 5 things you must stop buying immediately if you want to harness the geometric force of compound interest. This is not motivational speaking. This is a forensic analysis of wealth preservation based on 99 years of wisdom. Before we dissect the mathematics of these financial traps, make sure to subscribe to the Charlie Munger Academy YouTube channel. Join us as we decode the mental models of the world's greatest investors. Part 1. The Mathematics of Ruin. We begin our descent into the architecture of financial failure with the single most destructive force known to capital markets. It is not inflation. It is not taxation. It is not geopolitical conflict. It is the seduction of leverage. Charlie Munger, a man whose mind operates with the precision of a Swiss chronometer, has spent nearly a century observing the wreckage of brilliant men who crashed against the rocks of debt. He famously categorized the 3 ways a smart person goes broke: liquor, ladies, and leverage. While the first 2 are personal failings, the third, leverage, is a mathematical inevitability designed to punish impatience. To understand why you must stop buying leverage immediately, we must move beyond simple advice and enter the realm of probability theory and the unforgiving mechanics of the absorbing barrier. Buying leverage is, in essence, the act of purchasing impatience. You are renting money to bridge the gap between where you are and where you feel you deserve to be. But the cost of this rental is not merely the interest rate you pay to the bank. The true cost is the introduction of a catastrophic fragility into your portfolio. When you invest with cash, you own an asset. When you invest with leverage, you own a liability wrapped in an asset. The distinction is critical because it fundamentally alters the path dependency of your wealth. In a cash account, volatility is merely noise, a fluctuation in quoted price that can be ignored if the underlying value remains sound. In a leveraged account, volatility is not noise. It is a weapon. It is a force that can trigger a mandatory liquidation event, forcing you to sell your assets at the precise moment they are most undervalued. This is the difference between experiencing a storm from the safety of a lighthouse and experiencing it from a leaking raft. Consider the historical tragedy of Rick Guerin. This is a story Charlie Munger tells with a somber tone, for it illustrates that high intelligence offers no immunity against the mathematics of leverage. In the 1,970 seconds, Warren Buffett, Charlie Munger, and Rick Guerin were the trio of super investors. They were friends, they were intellectual peers, and they were all compounding capital at extraordinary rates. In the famous essay, The Super Investors of Graham and Doddsville, Buffett listed Guerin alongside himself. Yet, if you look at the history of Berkshire Hathaway today, you see Buffett and Munger. You do not see Guerin. The reason is not a lack of skill. Guerin was arguably as sharp as Buffett. The reason was leverage. During the brutal bear market of 1973 and 1974, the U.S. stock market collapsed. It was a slow, grinding decline exacerbated by the oil shock and stagflation. Berkshire Hathaway shares fell from a high of nearly $90 to roughly $40. For Buffett and Munger, who operated with safe capital structures, this 50% decline was painful on paper, but irrelevant to their solvency. They simply waited. They understood that the intrinsic value of their holdings had not evaporated, only the market price had. But Rick Guerin had bought leverage. He had borrowed money against his portfolio to amplify his returns, driven by a desire to get rich faster. When the market dropped 50%, the mathematics of the margin loan took over. The banks did not care about Guerin's IQ. They did not care about the long-term intrinsic value of his stocks. They cared only about the collateral. As the prices fell, Guerin was hit with margin calls. To satisfy the lenders, he was forced to sell his Berkshire Hathaway shares at the very bottom of the market. He sold shares for $40 that would eventually be worth hundreds of thousands of dollars each. He was mathematically wiped out because he could not endure the volatility. Buffett later bought those shares from him. The lesson here is terrifying in its simplicity. If you cannot survive the dip, the destination does not matter. Leverage introduces a path-dependent risk where the sequence of returns matters more than the average return. Even if your long-term thesis is correct, leverage can bankrupt you before the long-term arrives. We must analyze this through the lens of the ergodicity problem in economics. In a non-ergodic system, which the stock market is the average outcome of the group, is different from the outcome of the individual over time. If 100 people flip a coin, the average is 50-50. But if one person flips a coin and goes bust on tails, they stop flipping. They are removed from the game. Leverage increases the probability of hitting that absorbing barrier, the point of zero equity. Once you hit zero, you cannot recover. The magic of compounding requires an uninterrupted chain of multiplication. If you introduce a single zero into that chain, the final product is zero. It does not matter if you had 10 years of 50% returns prior. 1 year of minus 100% wipes the slate clean. Munger avoids leverage because he understands that to finish first, you must first finish. Let us look deeper into the mechanics of volatility drag on a leveraged portfolio. Imagine you have $100,000 and you borrow another $100,000 to invest $200,000. You are leveraged 2-to-1. If the market falls just 20%, your portfolio value drops to $160,000. However, your debt remains fixed at $100,000. Your equity is now only $60,000. You have lost 40% of your own money on a 20% market move. This is the double-edged sword. But the recovery is where the math becomes sadistic. To get back to your original $100,000 of equity from $60,000, you do not need a 20% gain. You need a 66% gain on your remaining equity. The hole you dig with leverage is always deeper than the hill you climbed. This asymmetry is what destroys wealth. You are fighting against gravity. Furthermore, leverage strips you of your greatest advantage as an individual investor, the ability to do nothing. When you own stocks with cash, you have the luxury of indifference. The market can close for 5 years, and you will be fine. When you have debt, you are on the clock. You have interest payments to meet and collateral ratios to maintain. Your time horizon shrinks from decades to days. You become a slave to the short-term gyrations of the market. Charlie Munger and Warren Buffett built Berkshire Hathaway by being willing to look foolish in the short term to be right in the long term. Leverage forces you to look smart every single day, and that is an impossible standard. The history of financial crises is essentially a history of leverage unwinding. Look at long-term capital management in 1998. This firm was run by Nobel laureates, men with the highest IQs in the financial world. They built models that stated a catastrophic market event was a statistical impossibility, a 6 sigma event that would not happen in the lifetime of the universe. Consequently, they levered their portfolio up to 100-to-1 in some instances. When the Russian debt default occurred, the impossible happened. Their leverage turned a manageable loss into a systemic threat that nearly collapsed the global financial system. The Federal Reserve had to intervene. Munger cites this often not to mock them, but to warn us. If Nobel Prize winners can be ruined by leverage because they underestimated the tail risk, what chance does the average investor have? The seduction of leverage often comes disguised as low-risk arbitrage or real estate investing. People believe that if the asset is safe, the debt is safe. This is a delusion. Safety is a function of the balance sheet, not just the asset. A safe house purchased with 95% debt is a risky investment. During the 2008 financial crisis, millions of Americans discovered that their safe homes were actually highly leveraged derivative positions on the U.S. housing market. When prices corrected, they were underwater. They owed more than the asset was worth. This trapped them, destroying their mobility and their financial future. Munger's philosophy is to reverse this. He prefers a fortress balance sheet, more cash than necessary, zero reliance on the kindness of strangers. We must also consider the psychological toll of leverage. Munger places a high value on a life free of anxiety. When you are leveraged, your cortisol levels rise with the volatility index. You check prices constantly, you lose sleep. You make emotional decisions based on fear rather than rational decisions based on value. This cognitive degradation is a hidden cost of debt. A mind clouded by the fear of a margin call cannot allocate capital efficiently. By refusing to buy leverage, you are buying peace of mind. You are buying the clarity of thought required to act aggressively when everyone else is panicking. In 2008, when the leveraged world was forced to sell, Buffett and Munger were buying billions of dollars of securities at distressed prices. They could do this only because they had no debt. They were the liquidity providers to a leveraged world that had run dry. The argument for leverage is always based on the assumption of a smooth future. It assumes that the future will look somewhat like the past, with standard deviations falling within a bell curve. But Munger knows that the financial world is governed by fat tails, extreme events that happen far more often than models predict. A pandemic, a war, a sudden regulatory change, a flash crash, these are the events that wipe out the leveraged investor. If you are unleveraged, these events are buying opportunities. If you are leveraged, they are extinction events. You are effectively picking up pennies in front of a steamroller. You might pick up a lot of pennies for a long time, and you might feel very smart doing it, but eventually, the steamroller arrives. Therefore, the first step to getting rich, according to the Munger Academy of Thought, is to eliminate the possibility of total ruin. You must construct a financial life that is robust to shocks. This means rejecting the margin account. It means rejecting the urge to maximize returns in the shortest possible time. It means accepting that you will get rich slower than your neighbor who is levered to the hilt. But you must remember the fable of the tortoise and the hare. In the financial markets, the hare does not just lose the race. The hare dies of a heart attack at mile 2. The tortoise finishes. The inescapable conclusion of analyzing leverage is that it is a tool that offers a slightly higher ceiling at the cost of a non-zero probability of a collapsing floor. For a rational person, a non-zero risk of ruin is unacceptable, no matter the potential reward. Stop buying leverage. Stop trying to outsmart the arithmetic of volatility. Embrace the boring, slow, inevitable path of unleveraged compounding. It is the only path that guarantees you will reach the finish line. When you look at the graph of Berkshire Hathaway's performance, do not look at the height of the peaks. Look at the absence of valleys that go to zero. That is the secret. That is the discipline. That is the foundation upon which all other wealth is built. Without this foundation, you are building a skyscraper on a fault line, waiting for the inevitable tremor to bring it all down. Part 2. The parasitic nature of friction. We move now to the second great destroyer of capital. A force more insidious than leverage because it is invisible to the untrained eye. It is the force of friction. In physics, friction opposes motion and dissipates energy as heat. In finance, friction opposes the accumulation of wealth and dissipates capital as fees. Charlie Munger, with his characteristic bluntness, identified the investment management industry not as a value creator, but largely as a value extractor. He likened the vast machinery of Wall Street, the hedge funds, the consultants, the wealth managers to the croupiers in a gambling hall. The croupiers do not care if the players win or lose. They care only that the wheel keeps spinning, for every spin generates a commission. To get rich, you must stop buying the services of these croupiers. You must stop buying the illusion that complexity equals performance. You must stop buying friction. The financial industry is built on a fundamental asymmetry of information and a potent psychological trick. The belief that you get what you pay for. In almost every other aspect of human existence, this heuristic holds true. A Ferrari is faster than a Ford. A bespoke suit fits better than a generic one. A private surgeon offers better care than a crowded clinic. Therefore, the wealthy naturally assume that paying high fees for exclusive financial management must yield superior results. Munger teaches us that in the capital markets, this rule is inverted. In investing, you get what you don't pay for. Every dollar paid in management fees, performance fees, trading commissions, and administrative costs is a dollar that is permanently removed from the compounding engine. It is not merely a cost. It is the destruction of future geometric growth. To understand the mathematical violence of fees, we must look beyond the nominal percentages. A 2% management fee sounds benign. It is a small number. But this is a deception of framing. You must not view the fee as a percentage of your assets. You must view it as a percentage of your returns. If the market generates a gross return of 7%, which is a reasonable historical expectation, and you are paying 2% in total fees to a manager and the underlying funds, you are not giving up 2% of your wealth. You are giving up nearly 30% of your profit. You are taking 100% of the risk, supplying 100% of the capital, and yet you are handing over nearly 1/3 of the harvest to a manager who takes zero risk. Over a lifetime of investing, this friction does not just reduce your wealth, it decapitates it. The definitive historical proof of this concept is the Buffett bet, an event that should be taught in every economics classroom in the world. In 2007, Warren Buffett, acting on the same principles held by Munger, wagered $1 million that a simple, low-cost S&P 500 index fund would outperform a basket of the world's most elite hedge funds over a 10-year period. The opponent was Protégé Partners, a firm that selected the best of the best funds run by geniuses with advanced algorithms, insider connections, and aggressive strategies. These funds charged the standard 2 and 22% of assets and 20% of profits. The narrative sold by the hedge fund industry was that they could provide alpha, or returns above the market, and downside protection during crashes. 10 years later, the results were unassailable. The S&P 500 index fund, which simply bought the market and did nothing, returned an annualized 7.1%. The basket of elite hedge funds returned a meager 2.2%. The difference was almost entirely attributable to fees. The hedge fund managers drove Ferraris bought, with the friction costs paid by their clients. The clients received subpar returns. Munger points to this as evidence of a gigantic parasitic activity where wealth is transferred from the patient capital owners to the hyperactive intermediaries. We must also scrutinize the role of the financial consultant. Munger often notes that if you go to a barber and ask if you need a haircut, the answer is always yes. Similarly, if you go to a financial consultant and ask if you need a complex portfolio rebalancing strategy, the answer is always yes. This is the principal-agent problem in its purest form. The agent, the consultant, is incentivized to justify their fees by making activity. They cannot simply say, "Buy a low-cost index fund and call me in 20 years, because then you would stop paying them." Therefore, they invent complexity. They sell you on tactical asset allocation, smart beta, and alternative investments. This complexity serves a dual purpose. It generates fees, and it appeals to the client's ego. It feels sophisticated to own a portfolio that includes derivatives, private equity, and commodities. It feels pedestrian to own a vanilla index fund. But Munger warns that complexity is the enemy of execution. The more moving parts in a machine, the more likely it is to break. The more layers of management between you and the underlying asset, the more mouths there are to feed. The fund of funds model is perhaps the most egregious offender, where you pay fees to a manager who selects other managers who charge fees to select stocks. By the time the return reaches you, it has been filtered through multiple layers of croupiers, leaving you with the husks of the harvest. Let us analyze the zero-sum game nature of active management. For every buyer, there is a seller. In the aggregate, the market return is the average of all participants. However, the market return minus fees is the mathematical reality for the investor class. Since the industry charges high fees, the average actively managed dollar must underperform the average passive dollar. This is not a theory, it is arithmetic. By hiring a consultant to pick winning stocks, you are essentially betting that your consultant is smarter than the collective wisdom of the entire market, including algorithmic trading systems and institutional giants. Munger suggests this is arrogance. It is far more rational to admit that you cannot beat the market and instead choose to be the market, paying virtually zero in fees to do so. This brings us to the concept of churn. Friction is not just the annual management fee, it is the transaction cost of buying and selling. High-frequency trading and constant portfolio turnover generate taxes and commissions. Munger and Buffett are famous for their lethargy. They buy a stock and hold it for decades. This extreme inactivity is a strategic weapon. By never selling, they never interrupt the compounding process with capital gains taxes. They never pay a broker a commission to exit a position. They let the float work for them. In contrast, the typical mutual fund turns over its portfolio significantly every year. This churn creates a tax drag that is invisible in the pre-tax performance charts but devastating in the real world. By buying the services of active managers, you are buying a tax inefficiency machine. There is also a moral dimension to Munger's critique. He views the vast expansion of the finance sector as a drain on civilization's talent. We have the brightest minds in physics, mathematics, and engineering bypassing productive fields to go into high-frequency trading and derivative structuring simply because that is where the fees are. They are not curing cancer or building bridges. They are figuring out how to shave a microsecond off a trade or structure a fee-heavy product for pension funds. By refusing to buy these products, you are not only saving your own wealth, but you are also refusing to subsidize a system that Munger believes does God's work only in the sense that it tests the resilience of the human spirit against greed. The psychological difficulty in rejecting friction lies in the desire for control. We feel that if we pay an expert, we are doing something responsible. It feels reckless to manage one's own financial destiny with a simple algorithm. But the data suggests that the most responsible action is the one that minimizes the extraction of value by third parties. You must ruthlessly audit your investment life. Look at the expense ratios of your funds. Look at the advisory fees on your statements. Calculate the compound future value of those fees over 20 or 30 years. You will likely find that you are paying the price of a luxury home to a stranger, simply for the privilege of having them underperform a computer program. Munger's approach is the Lollapalooza effect of cost reduction. If you eliminate the management fee, eliminate the performance fee, eliminate the trading friction, and eliminate the tax drag, these factors combine to produce a result that is nonlinearly better than the alternative. You retain the full force of the market's return. It is the financial equivalent of removing the brakes from a car. You do not need a bigger engine, higher risk. You simply need to stop pressing the brake pedal, friction. Ultimately, stopping the purchase of friction requires a shift in identity. You must stop viewing yourself as a client of the financial industry and start viewing yourself as the custodian of your own capital. The industry is designed to make you feel dependent, to make finance seem like a dark art that only the initiates can practice. Munger strips away this veil. He reveals that the secret of the high priests of finance is mostly marketing disguised as mathematics. The emperor has no clothes, but he has very high fees. When you stop buying the services of the helpers, the consultants, and the managers, you are not stepping into chaos. You are stepping into the clarity of pure ownership. You are aligning your capital with the productive capacity of businesses, rather than the fee-generating capacity of intermediaries. The path to wealth is paved with the fees you did not pay. It is built on the realization that in the world of money, the most valuable service you can buy is usually the one you provide for yourself. The discipline to do nothing cheaply. Part 3. The Illusion of Wealth. We arrive now at the third pillar of Charlie Munger's philosophy of subtraction, a category of financial behavior that requires us to distinguish between the act of investing and the act of speculation. To build enduring wealth, you must stop buying non-productive assets. This includes the ancient obsession with gold and the modern hysteria surrounding cryptocurrencies. Munger's disdain for these asset classes is not born of a refusal to embrace the future, but rather from a rigorous understanding of what constitutes value. In the Munger taxonomy, there are two types of assets: those that bleed for you and those that feed you. Productive assets, businesses, farmland, real estate produce cash flows, dividends, and utility. They have an internal heartbeat. Non-productive assets have no internal life. They are sterile. They never produce a crop. They never write you a check. They merely sit there, looking at you, waiting for a greater fool to come along and pay a higher price for the privilege of staring at them. To grasp why you must stop buying these sterile assets, we must perform a thought experiment that Munger and Warren Buffett have popularized, one that exposes the absurdity of non-productive hoarding. Imagine you could buy all the gold in the world, every ounce, every bar, every ring. You would have a cube of metal roughly 67 feet on each side. You could climb on top of this cube, you could fondle it, you could polish it, but it will not respond. It will not produce anything. Now, imagine with that same amount of capital, trillions of dollars, you could buy all the farmland in the United States, plus 7 ExxonMobils, and still have $1 trillion left in cash. The choice is an intelligence test. If you choose the farmland, every year you have a harvest. You have corn, wheat, and soy to feed the world. If you choose the businesses, every quarter you have dividends and earnings. A century from now, the farmland will still be producing food, and the businesses will have expanded. The cube of gold, however, will still be the exact same size. It will not have grown an inch. it will remain a shiny, inert monument to fear. Munger argues that civilized people invest in productive capacity that advances civilization, not in rocks that do nothing. Buying gold is a bet against human ingenuity. It is a bet that the world will become so chaotic that a shiny metal is the only thing left of value. Munger prefers to bet on the resilience and productivity of the human species. We must look at the historical data to validate this. According to the seminal research by Professor Jeremy Siegel of the Wharton School, the divergence in returns between productive and non-productive assets over the last 2 centuries is staggering. If you had invested $1 in gold in 1802, adjusted for inflation, that dollar would be worth roughly $4 today. It has barely maintained its purchasing power. It is a store of value in the same way a freezer is a store of food it preserves, but it does not create. However, if you had invested that same dollar in the stock market, a collection of productive enterprises, it would be worth well over $1 million today. The difference between $4 and $1 million is the difference between a sterile asset and a productive one. By buying gold, you are effectively opting out of the economic engine of capitalism. You are choosing stagnation. But if Munger is dismissive of gold, his view on cryptocurrency is one of visceral, moral, and intellectual opposition. He has famously described Bitcoin as rat poison squared, venereal disease, and an open sewer. While these colorful metaphors garner headlines, the underlying financial analysis is profound. Crypto represents the ultimate non-productive asset. It is not even a physical rock you can hold. It is a digital entry in a decentralized ledger. Its value is derived entirely, 100%, from the greater fool theory. The greater fool theory states that you can make money buying something overvalued as long as there is someone else, a greater fool, willing to pay even more for it later. This is not investing. This is a Ponzi-like redistribution of wealth. When you buy a share of a company, you are buying a claim on future cash flows. Even if the stock market closes for 10 years, the company will ideally still make profits and send you dividends. If you buy a Bitcoin and the trading market closes, you have nothing. You have no claim on earnings, no claim on assets, no utility. You are simply holding a digital token, hoping that excitement and marketing will drive the price up. Munger considers this, trading turds, a harsh but accurate description of an asset class that generates no yield. Furthermore, Munger's critique of crypto extends to the ethical and civilizational level. He believes that a currency should be stable and backed by the sovereign power of a nation-state to facilitate commerce. A currency that fluctuates 20% in a day is useless as a medium of exchange. It is useful only as a vehicle for speculation and, as Munger points out, for kidnapping, extortion, and tax evasion. By buying crypto, you are not investing in the technology of the future. You are participating in a speculative mania that undermines the stability of the global financial system. Munger laments that the United States government allowed this genie out of the bottle, viewing it as a failure of regulatory will. The psychological trap of non-productive assets is the allure of easy money. We see the neighbor who bought Dogecoin or a junior gold miner and made 1,000% return in a month. It triggers the envy center of the brain. Munger warns that someone will always be getting richer than you, faster than you. This is not a tragedy. The tragedy is abandoning your rational framework to chase their luck. The people who made fortunes in the Dutch tulip mania of the 1,630 seconds looked like geniuses right up until the moment the market collapsed. Speculative bubbles in non-productive assets always follow the same trajectory: displacement, boom, euphoria, profit-taking, and panic. When you buy these assets, you are sitting at a poker table where you cannot calculate the odds because there are no underlying fundamentals to calculate. You are playing blind. Let us analyze the store of value argument often used to defend these assets. Proponents argue that with central banks printing fiat currency, one must hold hard assets. Munger agrees with the premise but disagrees with the solution. Yes, cash is a poor long-term investment because of inflation, but the hedge against inflation is not a sterile rock or a digital token. The hedge is a business with pricing power. If the currency devalues, a strong business like Coca-Cola or Apple can simply raise its prices. Its earnings will inflate along with the currency, preserving the purchasing power of the shareholder. Productive assets are a living, breathing hedge against inflation. Non-productive assets are a speculative gamble on fear. There is also an opportunity cost to consider. Every dollar you deploy into gold or Bitcoin is a dollar that is not working in a compound interest engine. It is capital that has been taken out of the game. If you hold gold for a decade and it goes up merely with inflation, you have lost the 7 to 10% annualized return you could have earned in a low-cost index fund. Over a lifetime, this opportunity cost is measured in millions. You are paying a heavy price for the illusion of safety. Munger's portfolio is concentrated in things that do things: banks, retailers, energy companies. He wants his money to be working while he sleeps, not sitting in a vault. Moreover, the trading of non-productive assets promotes a gambling culture that Munger finds deeply corrosive. He equates the crypto exchanges to casinos, designed to exploit the dopamine loops of human psychology. It turns the serious business of capital allocation into a game of roulette. When a society devotes its best minds to creating new tokens and trading algorithms, rather than building infrastructure or solving complex problems, it is in decline. By refusing to buy these assets, you are refusing to participate in the casinofication of the economy. You are taking a moral stand for rationality. The argument is often made that blockchain technology has utility. Munger separates the technology from the token. One can appreciate the technical innovation of a distributed ledger without believing that a specific token is worth $60,000. The dot-com bubble of the late 1990 seconds involved real technology. The internet changed the world. But buying Pets.com was still a disastrous financial decision. Innovation does not automatically equate to investment value for the holder of the asset. Most of the early car companies went bankrupt, even though the automobile transformed civilization. Munger avoids the tech trap by sticking to what he understands and what produces predictable cash flows. To get rich, you must align your interests with the forces of production. You want to own the wind, not the wind vane. Productive assets harness the energy of human labor and ingenuity. They grow. Non-productive assets rely entirely on marketing and mass hysteria. When the music stops, and it always stops, the holder of the productive asset still owns a factory, a farm, or a patent. The holder of the non-productive asset owns a receipt for a tulip bulb. Charlie Munger's life was a testament to the power of rational allocation. He did not chase the hot trends. He did not buy gold in the 1,970 seconds inflation spike. He did not buy dot-com stocks in the 90 seconds. He did not buy crypto in the 2020 seconds. He bought businesses. And by doing so, he outperformed almost every speculator in history. The lesson is clear. Stop buying things that require a sales pitch to explain why they have value. Buy things that show you their value on an income statement. Stop buying the sterile. Start buying the productive. This is the only way to ensure that your wealth grows organically, rooted in the real economy, rather than floating precariously on the clouds of speculation. Part 4. The Cost of Envy. We have arrived at the final, and perhaps the most pernicious, obstacle standing between you and the accumulation of enduring wealth. It is not a market force, nor is it a banking product. It is a psychological defect hardwired into the human condition, the ego. Charlie Munger, in his infinite wisdom, diagnosed the root cause of financial mediocrity not as greed, but as envy. He famously remarked that, "The world is not driven by greed, it is driven by envy." To get rich, you must stop buying status. You must stop buying ego. You must stop participating in the status game, a zero-sum contest where the prize is the admiration of strangers and the cost is your financial freedom. In the lexicon of Charlie Munger and Warren Buffett, there is a fundamental distinction between the inner scorecard and the outer scorecard. The outer scorecard is defined by what the world sees: the brand of your car, the square footage of your house, the label on your suit. It is a fragile construct dependent on external validation. The inner scorecard is defined by what you know to be true: your net worth, your integrity, your discipline, and the compounding of your capital. Munger lived his entire life by the inner scorecard. He lived in the same modest house in California for over 60 years. He drove practical, unassuming vehicles. He did not dress to impress Wall Street. He dressed to be comfortable. This was not asceticism. It was a ruthless calculation of opportunity cost. To understand why buying ego is a financial death sentence, we must quantify the mathematics of consumption. When you buy a luxury item, let us say a $50,000 car to impress your neighbors, you are not merely spending $50,000. You are slaughtering the future productive capacity of that capital. you are destroying the seed corn before it can be planted. If you understand the rule of compounding, you realize that $50,000 invested today in a productive asset growing at 10% per annum is not $50,000. It is nearly $900,000 in 30 years. Therefore, the real cost of that car is not the sticker price. The real cost is a fortune lost. Every time you succumb to the urge to upgrade your lifestyle to match your income, you are resetting the clock on your compounding. You are eating your own future. Munger viewed the desire to keep up with the Joneses as a form of insanity. He observed that the Joneses are typically drowning in debt, fighting silent battles with solvency, and living paycheck to maintain the illusion of prosperity. By trying to replicate their consumption patterns, you are replicating their financial fragility. This is the hedonic treadmill. Psychologists and economists have proven that humans adapt very quickly to improved circumstances. The joy of a new mansion fades in months. The thrill of a new car evaporates in weeks. But the monthly payments remain. The property taxes remain. The maintenance costs remain. You are left with a higher burn rate and no increase in happiness, forced to run faster just to stay in the same place. Munger avoided this trap by keeping his burn rate incredibly low relative to his income, creating a margin of safety that allowed him to make rational investment decisions without the pressure of needing immediate cash. We must also analyze the concept of signaling through the lens of evolutionary biology, which Munger often referenced. Humans are social animals evolved to signal status to secure mates and hierarchy. However, in the modern financial economy, these biological impulses are maladaptive. They are glitches in our software. Buying liabilities to signal wealth is a false signal. It actually signals a reduction in wealth. True wealth is what you don't see. It is the portfolio that isn't touched. It is the dividend check that is reinvested. It is the freedom to walk away from a bad job or a bad deal. Munger teaches us that the highest form of status is autonomy, not consumption. Consider the Lollapalooza effect of ego-driven investing. When ego enters the investment process, disaster follows. We see this in CEOs who engage in massive mergers and acquisitions, not because the deal makes financial sense, but because they want to manage a bigger empire than their rivals. They overpay, they take on debt, and they destroy shareholder value to feed their own vanity. As an individual investor, you face the same risk. You might hold on to a losing stock because you refuse to admit you were wrong. You might chase a hot sector because you want to sound smart at a dinner party. You might trade frequently to feel active and in control. These are all manifestations of ego. Munger's genius was his ability to destroy his own best-loved ideas. He had no ego attachment to his positions. If the facts changed, he changed. By stopping the purchase of ego, you detach your self-worth from your net worth, which paradoxically allows your net worth to soar. The marketing machinery of the 21st century is designed to exploit your insecurity. It sells you the lie that you are investing in yourself by buying a designer watch or a luxury vacation. Munger would argue that the only true investment in yourself is the acquisition of skill, wisdom, and productive assets. Everything else is consumption disguised as investment. The danger lies in the confusion of assets and liabilities. A house is often called an asset, but if it drains cash from your pocket every month and requires constant capital injection, it behaves like a liability. Munger and Buffett have often pointed out that for most people, a home is a consumer durable, not an investment. Yet, people overextend themselves to buy the biggest house the bank will allow, becoming slaves to a mortgage, effectively working for the bank for 30 years. This is the ultimate victory of ego over arithmetic. To get rich, you must cultivate what Munger called a disposition of patience and rationality. This requires a level of indifference to public opinion that is rare. You must be willing to look like a fool in the short term to be a king in the long term. While your peers are leasing new cars every 3 years, you are driving a 10-year-old sedan and buying index funds. While they are discussing their exclusive club memberships, you are reading annual reports. This path is lonely. It lacks the dopamine hit of instant social validation. But the destination is financial impregnability. Munger's life offers the ultimate counter-narrative to the fake-it-till-you-make-it culture. He did not fake it. He made it. And then he still didn't flaunt it. He understood that wealth is a tool for independence, not a billboard for validation. The money gave him the freedom to speak his mind, to study what he wanted, and to associate only with people he respected. That is the true utility of money. When you spend money on status, you are trading that freedom for a fleeting moment of attention from people who do not care about you. It is a bad trade. It is an irrational trade. Therefore, the final instruction from the Munger Academy is to ruthlessly excise the need for external approval from your financial decision-making process. Inspect every purchase. Ask yourself, am I buying this because it has utility and value, or am I buying this to project an image? If the answer is the latter, do not buy it. Take that capital and feed it into your compounding engine. Let the magic of geometric growth work for you. By rejecting the status game, you win the wealth game. You escape the rat race not by running faster, but by stepping off the treadmill entirely. This concludes our analysis of the Charlie Munger method. We have traversed the dangers of leverage, the parasitism of friction, the futility of non-productive assets, and finally, the destructiveness of ego. These are the four horsemen of financial ruin. If you can build a fortress that excludes these four enemies, you will not just be rich, you will be wealthy in the truest sense of the word. You will possess the sovereignty over your own time and the clarity of a rational mind. Charlie Munger has left the building, but his blueprints remain. The architecture of wealth is available to anyone with the discipline to read it and the character to follow it. The choice is now yours. You can continue to buy what the world sells you: debt, fees, hype, and status, or you can stop. You can subtract your way to abundance. If this series has added value to your mental models, if it has sharpened your lens on the world of finance, then your next step is logical. Click the subscribe button for Charlie Munger Academy right now. Join a community dedicated to the pursuit of rationality and the preservation of capital. We do not promise you overnight riches, but we promise you the truth. Subscribe, invert, and prosper.